Welcome back to another video. Sohail here, and today I want to teach you how you can use ATR to set stop loss for your open positions. ATR, or its original name Average True Range, was developed by the famous technical analyst J. Wells Wilder and introduced in his 1978 book New Concepts in Technical Trading Systems. Other well-known indicators like RSI, ADX, and Parabolic SAR are also developed by Wells Wilder and included in the book. ATR is available on most of trading platforms and on TradingView. For adding it to our chart, here we click on indicators and we search ATR. This one, Average True Range. Alright, this is the ATR, and before we see how we can use it for setting stop loss, let me explain what ATR is and how this line is interpreted, because it's important to know what this indicator does before making any sense to use it for setting stop loss. When you look at the price chart, you see that the price is always fluctuating up and down, and even if you consider one candle and for that time period check the lower time frame, you see the price fluctuations up and down in that time period. When you look at this chart for every time period, which is represented by a candle, you can see that the range between high and low is different for different time periods. Sometimes the range is larger and sometimes the range is smaller. Just look at the low to high of each candle and you can clearly see that they are in different sizes. ATR measures the average degree of volatility, which is actually the price fluctuations in a specific period of time, by the help of these ranges. Wells Wilder realized that only looking at low to high of each candle and not taking the gaps into account is not a good measure of volatility, so he developed ATR indicator, which also considers the previous candle close and uses actually true range. So the name of this indicator, Average True Range. For defining the true range, he calculated current high minus current low, current high minus previous close, current low minus previous close, and then by considering the absolute value, the greatest one is the true range. And finally, a moving average is calculated based on these true ranges, which is this line that you see here. The default length for the moving average is 14, and this is what Wells Wilder suggested, but depending on your trading strategy and volatility of the market that you're trading, you may need to increase the length. So ATR will measure longer term volatility and you will have a slower line here, or you may need decrease the length, so it will measure shorter term volatility and you will have a faster line here. So make sure you test with different settings to see what ATR length better matches with your trading strategy and volatility of the market that you're trading. Alright, when ATR is rising or we have high ATR value, it means that the range of the candlesticks, the distance between lows and highs, are getting larger, as you can see here. So when we have rising in ATR, or relatively we are getting higher values for ATR, like what happened here or what happened here, it means that the range of the candles are large. And when ATR is declining, or we have low value of ATR like here, or for example here or here, it shows that we have a series of candlesticks with smaller ranges. Please pay attention that high ATR values are the result of sharp advancing of the price or also sharp declining of the price, so it's unlikely to have ATR remained high for an extended period of time. ATR is not used for generating signals on the direction of the price movements, and it's only used for measuring volatility. And ATR is more commonly used among traders for setting stop loss. When we set stop loss based on ATR, we are actually considering volatility, which are sharp movements of the market or consolidation periods. So by the help of ATR and considering volatility in our stop loss, we adapt to the unusual price movements, including the gaps. ATR is more commonly used for setting trailing stop losses, but it can also be used for setting initial stop loss, which in this case it would be more suitable for scalping and day trading because of more gaps and volatility in shorter time frames, so taking them into account in our stop loss would be a good idea. But some traders prefer to set the initial stop loss based on support or resistance levels or other price action patterns, especially on higher time frames like swing trading or mid-term trading, and then they use ATR for trailing stop losses. For example, for this resistance level that is formed here on the price chart, Consider that when it's broken by the help of this candle, we entered a long position here at the opening price of this candle. And consider that we set our initial stop loss below this broken resistance level, for example, below the low of this breaking candle. And we intend to move our stop loss step by step as the price is moving so we can get the most out of our position. For this purpose, ATR will help us. When this candle is closed, we read the ATR value, which is 0.014, and then we multiply this in 1.5, which results in 0.021, and after that we subtract this 0.021 from the high of this candle. High of this candle is 1.03642 minus 0.021 equals 1.01542, and this is our new stop loss. So we move our initial stop loss and place it here exactly at 1.01542. In this example, we set the stop loss 1.5 ATR from the high of this candle, and we continue moving the stop loss like this after each candle is closed. And for a short position, we similarly set before the lowest price. We can also set the initial stop loss based on this method exactly the way that we set this, but as I said, it really depends on trading preferences. Please pay attention that in this example, we chose the multiple of ATR 1.5, and this multiple is usually a number between 1.5 and 3 depending on your risk management strategy, and also the more important factor, volatility of the market that you're trading. For example, when you're trading in a crypto market, you may need to give more room to the price action and the stop loss must be further away from your trade entry, so you must choose larger multiples. Or for example, for some less volatile assets like some stocks, you can choose smaller multiples for the ATR. So depending on the volatility of the market that you're trading, you can choose a multiple between 1.5 and 3. ATR is a great tool for measuring volatility of the market, but as I said, it's not used for trading decisions, but it's very popular and commonly used for setting stop loss because of the way it deals with volatility by considering the range of price changes in each time period. It has made it a wonderful indicator for setting trailing stop losses. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.